And I don't think that this little 10, 11% correction is going to be the lows. Now, historically, something like this I thought was pretty important. That it's not necessarily where you start, but it's how you finish. So we're off to our 18th worst start since 1928. And those even these crazy terrible starts. Look at this price return for the first 48 trading days. You notice some of these levels, like, yeah, they're awful, right? 2009, right out of the great financial crisis. 2020, that was during the COVID OPEX cycle from February to March. It's a horrible window. 1935, I don't even know why, right? Great Depression was 1929, but 2022 was the start of a bear market after a deleveraging that happened in late 2021. So we're off to a pretty rough start. So at least in my my career, my era, I saw that happen. I saw that happen. I saw that happen. And I saw that happen. I saw that happen. And here we are now. I'm watching it live. Even 2000, watching it live. So point is, we've had of these 17 worst starts. Of these 17 worst starts, 10 out of 17 times, the market still finished the year positive. So, and it's not an awesome stat, but it's about 58%. So is that a big enough edge to say I'm going to put all my money on the market finishing higher for the year? I mean, it's a calculated bet. But I'd say if you're at least protecting the downside, then yeah, you've got, probabilities on your side. You've got time on your side. If anybody's looking, let's say 3 to 5 years out, there's really not much to worry about. If you're looking 3 to 5 years out, there's not much to worry about outside of don't lose your butt if this market's going to fall, 20, 30%. Worst case is if we fall 20, 30, 40, 50%, I mean, there's a lifetime of wealth that can be generated in that type of drawdown. But the problem is are you going to survive it? But if the Fed, which is potentially going to be cutting rates this year, are they cutting rates into a recession? Maybe, and maybe it's not a Fed-caused recession, but the Fed will still be cutting when the market's still down anyway. So overall, here's my concern, and this is what I thought a lot about last week. This is how I kind of position a lot of my portfolio for the rest of the year. If this market is going to be, finding some lows and finding some resiliency, hooray. Do I think the all-time highs are possibly going to get tested this year? Maybe. I'm not sure if I shared this everyone on Friday last week, but let me go into this chart here. Okay, a couple things. Typically, if we get through the little lull of February and March, usually by March, April, the market picks itself up. We get a seasonal trend. This is called the pre-summer push. April, May, June, July, some of the biggest bull runs ever. So usually from, this is 70 plus years of trading. You get a nice seasonal trend right in here. If that is absent this year, we should all be hoping for a good Q4. But if it's absent, I don't know. This is all bets are off. This is like just going to be one of those years where you hope you don't get burned too badly. You're playing defense, and that's exactly what I'm doing. So point is, if we can get through this, which we had a nice little cleanse, the market was down 10 to 11% on the S&P, 13 to 14% on the NASDAQ, nearly double digits on the Dow. We've got the Russell down nearly 20% or right at 20%. I mean, that is in fact, I think I read this. This is the 6th fastest decline. So from peak to trough of over 10% on the S&P, that's the 6th fastest time it's ever happened. So, and again, does that mean anything? Not really. It just means that our cycles are so much more accelerated now that things move faster. But I don't think that the bottom is necessarily in. If we're going to have resiliency, what do we need to see? We would have to have inflation trending lower, Fed willing to cut. We'd have to have the consumer willing to spend, and the consumer still have jobs. Okay? If this can happen, and I'm saying the consumer as in like not the federal government worker, that cut those layoffs. I mean, I think right now Doge has I don't know if we've actually officially had the layoffs, but to what I'm reading, about 60,000+ jobs right now. It could be way worse. There could be hundreds of thousands of jobs. But for private sector, if we still have the consumer employed, we still have the consumer willing to spend and willing to kind of maintain cost of living standards, I mean, we probably need to see a housing market resiliency as well, which, we're starting to see some applications picking up. But inflation trending lower, we saw that last week. Does it continue that way? We'll find out. The Fed is willing to cut and be a little bit more dovish and accommodative. Okay, fine. But I think this is going to be needed for the markets to stay resilient. Okay, if all of a sudden we see that the consumer is unwilling to spend and consumers are losing jobs, and we're starting to see initial jobless claims ticking higher, we're starting to see continued jobless claims ticking higher. If the housing market is still kind of frozen, if interest rates aren't going down too much, if the Fed is, the Fed could be willing to cut, but in the wake of a recession, the Fed is going to be cutting and the market doesn't really care. The market's going to drop regardless. So the Fed isn't necessarily going to be saving the market, in my opinion. I don't think. So a Fed put could be way lower than what the market is sitting at right now. Everyone's talking about the Fed put. Right now, it's not even a Fed put. It is a Fed put and a Trump put / administration put. If there's no backstopping this market can clearly have a pretty nasty correction. Again, I'll look at the bigger picture, but I've already looked at like a 20% area that seems pretty doable to the downside. And that's not going to be a lot of fun for anybody, but I'm just saying that wouldn't be a huge surprise to see us ultimately get there if a lot of these things are kind of this current changing of the guard. This is becoming like the new normal with a austerity-driven administration, at least for the first 6 months, 9 months. Again, I think they're on borrowed time because midterms are going to depend on what they can get done. If nobody's happy with this current administration for the first 2 years, you're going to notice it in the midterms. You're going to have this big pendulum swing from one side or the other. It's going to be all Republicans, and then it swings back to Democrats, and they lose the House and they lose the Senate. There's no more majority, and then you're right back into nothing can get done. And then Democrats maybe come in swinging, and they're trying to put things forward. You got a president that's going to veto everything. Like, it's going to be back to gridlock again. Political circus is always happening, right? But point is, if we have a correction, we have an intermediate low, that's understandable. My biggest concern is that this is a setup for more bad stuff. And this is what's scary about the markets. The reality is everything could be okay, right? But the market is always forward thinking. And if the market thinks that there's a recession, if the market thinks there's more job cuts coming, if the market thinks that consumers going to be struggling and pulling back, the market prices that in. That's the downside. Even if we would technically not be in a recession, the market could show it. 6 to 8 months forward thinking. So that level of resiliency needs to be communicated now. Because if it's not, this market's going to start pricing in things that are worse. Or this reality that's kind of lining up for 6 to 8 months from now. If we don't get better news, then the market's going to price it in.
If you'd like to see more of our free daily chart of the days, make sure to join our Telegram channel if you have not already joined. And if you are already in the Telegram channel, make sure to hit that thumbs up button to support our work. Also, quick reminder that if you're looking for free tools and free education in the trading space, head over to a1trading.com. You can check out our free technical, fundamental courses and much more.